Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest and author of the Options Playbook. All right, we are taping this show today on Monday the 26th. So we're just going to jump into a few of the stocks that we've talked about recently. We've kind of been on a roll with long put spreads. We started by being bearish in the QQQs and the NASDAQ in general. And then last week we looked at a Meta trade, i.e. Facebook, and we used a long put spread in Meta to get bearish a little bit more short term. Now, on last week's show, we also talked about the fact that both the QQQ trade and the Meta trade had the same expiration date, which is September 30th. So I'm going to do a quick review of them, and it's mainly because of the pricing mechanisms. I've talked many times about long put spreads or long call spreads in the fact that you are buying one option contract that wants the market to either go up or down, and then you're selling an option contract that wants the market to basically stay neutral or go the opposite direction. You need some time decay, which means you need some time decay or a decrease in implied volatility for long call spreads and long put spreads to max out on the strategy. So because of that, last week when we looked at the QQQs, we were right on our direction, but it moved very quickly to the downside. So we still had a lot of time left. So the trade was profitable, but not quite as profitable as you might think, because the move to the downside on our long put spread happened extremely quickly. Implied volatility spiked, and that hurt our position, which will have a tendency to happen when markets go down. And then, but we really just didn't have enough time decay. So I want to spend some time looking at both of those strategies. And then we're also going to keep this theme, but we're going to look at a long put spread as protection, as insurance. And we're going to stay in the tech space, which really has struggled recently. One stock that has done fairly well, I use well trepidatiously, is Apple. It's kind of held its own. We're going to look at Google today, and it's mainly because Google just recently did their 20-for-1 stock split. It's a $100 stock right now. So after the stock split, the stock actually has been beaten up. It's trading at a fairly decent PE, but you still might be nervous. We're still in September. We still got October, two of the most volatile months. September has proven to be one of the worst investing months on the calendar. And I got to emphasize that past performance isn't always a guarantee of future results. And we're not done with the September yet, right? So maybe it can still pull it out. We still got a few days left for September to try to make a positive movement and end the month at just not being down. That would be wonderful for the S&P 500 index if we could say that happened in September. All right, so let's jump, and I'm going to jump into the graph on Meta, and we'll talk about what happened this week in the underlying stock. So last week when we looked at Meta, it was 9/20. This was the date this is a monthly chart on a daily basis. So on that day when we looked at Meta was trading at 148.98. We'll call it, 147.98. We'll round that up to 148. Well, it looks like since that trading day that we taped Stock Play of the Day, there really hasn't been a lot of concern because we were bearish in the market and each day ended up down. Well, the 22nd we actually ended up because we have a green candle, but the market was down in general. And the 23rd and 26th, now we see it down at 137.33. These are live markets that are moving, but obviously this is the direction that we wanted it to go in. So let's look at the trade. We did a 4-point wide trade in Meta. Here's the Ally Invest option chains. We're going to be talking about puts, so we're going to be looking at the right side of the chain. When we did the trade, we were straddling the stock price. The stock price, we'll call it 148. We bought a 150 put with the September 30th expiration and sold a 146 put. So to go back to my opening, the put that we bought wants the market to go down. The put that we sold wants the market to go up. One of the good features about this trade this week is that we only have 4 days remaining to expiration now that we're taping the show. So since we've had a little bit more time decay and we had a fairly dramatic move to the downside, it's down about over 8 points or 5.5% since we looked at this on the Stock Play of the Day. So with that mentioned, we have 4 days remaining. We had a solid move to the downside. We put this trade on for $1.95 or $195 plus commissions. And we wanted to make the risk equal in that the risk reward very balanced, I guess would be a better word. We were looking to try to pay right around 2 to make 2, and we were able to buy it for a little bit less. We got it for $195, and that means our upside on a 4-point wide spread, maximum it could trade for is 4 points. So the upside would be $205. And don't forget, we got commissions in that. And as always on all these trades, I have to let you know that none of these are meant to be recommendations. So I always have to emphasize that because we're just trying to learn here on the Stock Play of the Day. So if I scroll down on this, we see 137.50. It's actually down a little bit more than when I was actually looking at it a little bit earlier. So should be even doing a little bit better. So we got to scroll all the way down because this line is representing the in the money strike, the most at the money, I should say, strike. And so these puts that are in black are in, the ones that are in gray are out. We bought the 150, so I'm highlighting the 150 here. Go over to the right rail, put a little buy. All you got to do is just hit the little drop down and select buy or sell. So in this instance, we have the buy here on the 150. We sold the 146. I scroll down, it is now trading for $3.55. Now, the maximum, as we mentioned, is $4. I'm happy to take this trade off anywhere around this area. If anything, I'd maybe give them the last quarter, right? I would definitely have a good till canceled order in to sell at least $3.75, which would be 20 cents higher. But I would consider just taking it off right now because we're at about, well, close to 80, when I can make 80 to 90% of what the maximum the spread could trade for, I'm going to think about taking it off because that last, let's call it 10% to get to the maximum of the width of the spread, which means it would be trading for $4 because it's a 4-point wide spread. It's really hard to get that last little bit out. You need to be very close to expiration. We're 4 days away, but in my book, that's not close enough, right? And in the market's book, because we basically, well, right now it's 355. That's where my cursor is at. That means we got 45 cents that we'd be leaving on the table, considering that the market right now is well below the 146 strike, trading at 137.37. All right. So how would we exit the trade? I'm going to hit the trade button, put it in the right rail. This was the initial trade. We bought and we sold. So now we have to sell to close as opposed to buy to open, and then buy to close as opposed to sell to open. So the way that we'd look to exit the trade, and just like entering the trade, I never want to enter it at a market order, especially on a spread. I might do market orders if I'm trading something extremely liquid like the SPY and just something where the options have 1-point wide spreads in them. But very rarely do I ever enter a market order on any option trade. Okay, buy to open, I'm going to hit sell to close. Sell to open, I'm going to hit buy to close. All right, so right now we're seeing a credit of $3.53. If you wanted to, you could go and say, all right, I want to get a little bit more, $3.65. Never guarantee, whenever you put a limit order in, there's no guarantee that you're going to get that price. And then maybe even leave it, instead of a day, we go good until canceled. Well, basically good until the life of these option contracts. And I would probably just do it for the day because I want to see where the next day opens up. I don't like to do good until canceled orders. I mean, if I'm further away from the actual execution, I would consider it. In other words, if I did a 2-point wide spread and the spread was, or I paid $2 for a 4-point wide spread and the spread was trading for $2.50, right? So my goal would be to get $3.65, $3.75, something like that. I might put a good till canceled order in that scenario. So, once again, that's what that's what the options playbook is all about. And stock play of the day is that we're going to try to take strategies, apply them to the market conditions, not necessarily be recommendations on stocks, but also just learn from looking at executing trades and how the platform looks and how you'd want to enter a trade inside Ally Invest. All right. So that would be in order. If you're going to do it at market, or do it very close to market, I would go in and it was 355, put it right at that 355, hopefully get a midpoint fill and get out of it today, take the risk off the table and have a fairly profitable trade. All right. Now, one last thing I just want to highlight. If we roll down to the profit and loss graph, see how it looks a little different. Okay. So when we did this trade, the underlying stock, this is reflecting the current market prices, but it highlights the fact that here's where the stock was trading all the way up here when we put this trade on. And we mentioned that this line was fairly flat in the profit and loss graph last week. Now you see that the line is eventually morphing into the dotted line, which would be at expiration. Now you need it to continue on down a little bit more to get that last, I guess it was 45 cents, and get it to trade for $4. So we need two things to happen. We need time decay. We need the stock to stay where it's at or go a little bit lower. And as it goes lower, your profitability obviously goes up because we're bearish on the market. All right, so that's what the profit and loss graph would look like. Let's go and look at the QQQ trade because this was a different trade on a little bit higher price stock. When we looked at the QQQs, and I did mention that we would go over it this week, we have the same expiration, 4 days away. We bought the 301, sold the 295. So if I scroll down here, I have the trade all loaded. We bought the 301 here. We sold the 295. We were 6 points wide. And right now, because we did wait, we can get close to that 6 points. And it's mainly because last week we added another 7 days to that expiration date. And we were only up, I think, $1 on the trade. When we did this trade to start with, we should have been somewhere, well, we were 280. I have it written down in my note here, $2.80. Now we could get close to that $6 on the trade, which is the maximum width of the spread. So I'd be putting that order in to sell to close out at 590. I do not want the risk of the movement in the marketplace to try to make one dime on this trade. And it's kind of, well, the market is down from last week, but it's really amazing what time decay can do when you're buying long spreads. And the moral to my story is that if you are doing any type of spread, you have to think a lot about your expiration date that you're choosing because of this nuance. And part of the reason why I wanted to address it today on the stock play of the day. All right, so bearish theme has worked out 2 weeks in a row in the tech space. We did the QQQs, obviously looked at Meta, which is a part of the QQQ ETF. Or NASDAQ is maybe a more succinct word to say. If we look at today's trade, we're going to actually run and look at Alphabet, otherwise known as Google. Symbol that we're going to use today is GOOGL, which there are two symbols. They trade pretty much in tandem, not much difference between the two. One has voting rights, one does not. I mean, it had something to do with a split that they did a while back. But Google is GOOGL. The last trade today was 98.22. And if we look at this trade now, what I'm going to build this as, after the split, maybe you have 100 shares of Google. If you bought Google after the split, you were probably down on Google. There's a good chance that you're down on it. It still seems to be a fairly valued stock, trading around 18 times earnings, depending on where you're looking at it. And if you want to stay the course, but you're nervous, well, what could we do? Buying puts outright are expensive, but maybe you want to think about a long put spread. So as the title says this week, we're bullish but nervous on Google. That simple. Bullish but nervous. That means our best case scenario is that Google goes up and that it continues on up. Why? Because the concept is that we own 100 shares of Google. Last two trades were speculative bearish on the tech stocks and on the Qs. Now I'm saying that, well, if you happen to buy 100 shares of Google or maybe even 200 shares of Google because of the stock split, well, now you got a situation where you're probably down on it. How can I stay the course on Google but still feel confident? How can I hedge my portfolio? And one of the things about a hedge or insurance, if you will, it's not going to be cheap, but it will protect you. It will give you some protection. And if you think of car insurance isn't cheap either, but it gives you a protection, and you usually have a deductible, and that makes you feel fairly good while you're driving your car down the road to know that you have that insurance, that protection on your car. That's the concept here. I don't want to crash my car. I really don't have any desire to do that. So I want my insurance to expire worthless. But if it does happen, I have a fallback, and hopefully everybody will be okay. All right. So let's look at the Google. We got to be fairly quick here. Let's look at the Google option chains here at Ally Invest. So we got Google at 98.19 right now. And if I'm going to go out 25 days with insurance, I don't like to go out 4, 5, 6 months in time because it's very expensive on stocks. And if that's really the case, then you're probably more bearish than you think. If you think you need a 6-month insurance policy, well, maybe you should just think about selling the stock. And that's kind of my outlook. We're in September and October, a lot of volatility, a little bit scared about the markets in general. So if I were to do this, and there's nothing wrong with after 25 days, which I'm highlighting as the expiration here, October 21st, if I put on, I'm still nervous but bullish on Google, I could do another 25 days. So I kind of like the 14 to maybe 40-day time frame, depending on what's going on in the markets. Today we're going to use a 25-day option contracts. All right, so stocks at 98. We're going to buy the 90. What is this? The 95 strike. Okay, so 98 to 95. We're going to have a $3 deductible. Almost. Well, it makes the math fairly simple. If we're at 98, we say it's 100. We're about a 3% deductible, approximately, a little bit less than that, before our insurance would kick in. So our risk is down to 95. At 95, we have the right to take our 100 shares of stock and put it to somebody at 95. Now, that's a fairly expensive option contract. It's trading for $2.82. Not bad, but when you consider that, we got 3 points. You add the $2.82 to it. Your total risk, if you bought that option outright, would be $5.82 before your insurance would kick in. Now, I'm going to go down and say, well, I'm a little bit nervous about a fairly big movement. I'm going to go 10 points down. Now, I can pick wherever I want. You could sell the 90. It's going to obviously bring in more premium, but it's only going to protect you for 5 points. I'm going to go all the way down to 85, and I want to be protected for 10 points, which would be fairly catastrophic, right? We're talking about another 10% at these levels to the down, well, actually more than 10% if you put in the deductible, all the way down to 85 on Google. All right, quite simply, I'm buying this with the outlook that I want the market to go up because I own 100 shares. But I'm going to spend $2.13, $213 on my protective scenario here to help me stay long Google during these rough times in the marketplace. All right, so official right rail, using options as a hedge. I'm going out of the money as opposed to straddling the market like we did the last couple of weeks when we were more speculative. We're going to use this as a true insurance. We own 100 shares of Google. We're going to go out and buy to open. 1 October, 21 strike, 95 strike put, and at the same time sell 1 October 21st expiration, 85 strike put. We're going to do this at a net debit to the account of around, we'll make it $2.10 just to make it simple. Never a guarantee of the midpoint fill. It'll cost us $210 plus commissions to protect our 100 shares of stock. And be aware that if the market does go below 85, the maximum that this insurance or long put spread can trade for is $10. That's it for this episode of Options. That's it for this episode of Stock Play of the Day. I'm Brian Overby, the author of the Options Playbook. If you like what you are seeing right now, please click subscribe, ring the bell, and click a thumbs up. Thank you, and we'll see you on the next Stock Play of the Day.